Tuesday the 11th of August, 2026, and gold just refused to slow down. Spot prices ripped higher by 1.3% to $4,195.35, and at one point we even touched $4,217.95. That takes the year-to-date gain to a staggering 60%. But here is the headline that caught our eye this morning: ETF inflows are pouring in, yet Commerzbank has just published a distinctly skeptical outlook. So we have fireworks in the gold market, but one of Europe's biggest banks is effectively saying, hold your horses. That conflict is exactly what we need to unpack right now. Let's first examine why money is flooding into gold exchange-traded funds. A major driver is the US dollar, which has weakened noticeably, and Treasury yields, which keep sliding. When the dollar falls, gold becomes cheaper for buyers holding other currencies, and lower yields reduce the opportunity cost of holding a non-interest-bearing asset. On top of that, UBS, a $7 trillion asset manager, now predicts gold will climb toward $5,000 in the first half of 2027. Goldman Sachs previously issued a similar call. Chinese buying remains strong, institutional inflows are accelerating, and US spot Bitcoin ETFs have sucked in over $56 billion since January 2024, proving that hard asset appetite is not fading. All of this feels unstoppable, but Commerzbank sees cracks beneath the surface. So why is Commerzbank reluctant to join the celebration? Their research points to fading physical demand. Total gold demand is forecast to fall 2% across 2026. Jewelry consumption is softening, particularly in price-sensitive markets where record highs deter buyers. More critically, central bank purchases, which were a pillar of the rally, are expected to slow. Yes, ETF inflows and bar and coin investment are rising, but Commerzbank's argument is that paper demand cannot fully replace missing physical offtake forever. In short, the rally may be narrower than it appears, driven more by momentum than by genuine broad-based demand. That is a sobering view when the metal is sitting near all-time highs. Here is where it gets tense for anyone holding a gold position today. A crucial US jobs report looms on the calendar, and that single data print could validate either the bulls or the skeptics. A weak number would likely push yields even lower and send gold toward that $5,000 target faster, while a surprise to the upside could snap the dollar back and trigger a sharp correction. ETF inflows alone have never been a foolproof shield. We have seen episodes in the past where strong fund buying masked underlying demand weakness, only for prices to correct violently when sentiment shifted. Right now, both UBS and Goldman Sachs are long-term bullish, but Commerzbank's caution highlights real near-term vulnerability that every investor must price in. The takeaway for Tuesday the 11th of August is not that you should dump your gold, but that you must avoid blind chasing. A 60% year-to-date rally is rare, and when a heavyweight like Commerzbank questions the foundations, it pays to listen. Consider whether your portfolio is truly balanced for a scenario where ETF inflows stall or the jobs data surprises. Diversification, not concentration, is the name of the game. Keep a close eye on jewelry demand data and central bank commentary in the coming weeks. Finally, remember that even the strongest bull markets take nasty pauses, and being prepared for a correction is exactly what separates disciplined investors from the crowd. Thank you for watching, and do subscribe for more daily market clarity.